Okay, well, we'll see if it does record and go from there. Usually longer files will have an issue, but I will try and record it. Probably split it up into a couple videos, and then that way we'll go from there. Anyways, to begin, I just want to, we get a lot of questions about the strategy itself, and I wanted to give some basic answers to your questions on where to come from, what's our background, yada yada about, just again the very basics. So just to give it a little background on me, guys, if I got my start in forex probably the same way everybody else did, and I'm just gonna do a real quick intro into it. And with that start, eventually down the road, I started to work for the Diamonds Room. You guys may have heard of Forex Peace Army. I'm sure everybody's been to Forex Peace Army. They used to run a room called the Diamonds Room, and it was a room before rooms were really cool, and it was more or less based on news, based on trading the news, because that was 4 or 5 years ago. News trading used to be a lot easier. News trading used to actually work. So that's really where I had my start. Got into trading, got into trading news and teaching different parts about how the market works, how to spot banking activity. The stop run reversal video is really the first video in the base of this type of strategy that is towards spotting manipulation in the market. Manipulation is the one thing in this market that gives us an extremely high degree of certainty as to the next direction of the market. Because, and again, we'll get into the basis of that, but that was a video that you can see on YouTube. It was a couple years back, put that on there. But the principle of the strategy is something that is really very basic, and that's what I wanted to get into a bit and talk about, and then we'll kind of bring it over to the charts and discuss how we traded on the charts. And the basic principle is that there's 10 banks that control well over 50% of the volume in this market. So given that basic fact, given that the fact that 10 banks control well over 50% of the volume, they have no choice but to accumulate positions over the course of time. It's not like you and I that simply just presses buy or sell, and again, we enter the market and buy it in expectation of a rise or sell in expectation of the market going down. Smart money has to induce buying to sell into buying pressure, or induce selling to buy into the selling pressure. So again, because of the position size they enter, that's where the you know that's where the big issue with retail traders comes in, because retail traders rely on the market going up to start to trigger a buy, and smart money is exactly the opposite. They rely on the market creeping up, pushing past highs to induce that buying, and they're selling into that buying pressure. So it puts us at odds with the banks, and that's the basis of what we do here. That's again the foundation, the fact that banks have to accumulate these positions. And so our single question then becomes, once we spot accumulation, what are the banks accumulating? Really what the single question comes down to. It doesn't boil down to anything more complicated than that. And one thing that I'll say, and it's one thing that you probably, if you listen to the video on the Forex course page of the site, there's a statistic out of the CFTC, and it's the fact that this is again from the brokers, and it relates how many people are profitable on a quarterly basis. One thing I always like to say is, let's assume every single strategy is profitable. If that's the case, then at best, based on those numbers, people have a 25% chance of quarterly success. And the one thing I always say is, if that's the case, who would ever enter this business? And so the basic model is broken. That's, again, I recommend going through the articles on the site. It kind of explains why that model is broken. And one thing I always say is there's three people that teach this in this market. And you guys have probably heard of them, because everybody in this market tends to get around. There's us. There's a guy named Martin Cole, and there's a guy named Steve Morrow. I can speak to Martin Cole. Martin Cole is very knowledgeable. I've seen his stuff. He's very knowledgeable. While I don't use his volume based stuff, and I don't personally feel it's applicable to what I do, I know the guy is very knowledgeable, and we have a lot of Steve's members, whether current or old, whatever it may be, and they speak highly of him. And so what I always say is, if you're gonna learn this market, learn it from one of the three. We're not here to pitch you. In fact, I recommend go look at them. We just want to guide people on the right course, whether that's with us or with somebody else. There's three people that teach essentially the same thing in this market, and that makes a lot of sense because a lot of traders are stuck looking at the charts, looking at trading the chart at face value. I always say if you trade the chart at face value, you'll end up with the same results as everybody else trading the chart at face value. So again, search out at least one of them, learn again what the banks do. So that's what we're going to get into here, and we're going to get into again the very basics of it. So to begin, what we're first going to talk about is we're going to go back over some things in spot accumulation, generally when we tend to see it, and we're going to point out a couple things that somebody could take away whether they understand the whole strategy or not, because I can't teach everything all in once. So what I can do is I can give away what I feel would be the most valuable to somebody in the shortest amount of time. And the two things that tend to be the most valuable is the stop run, number one, and also the manipulation out of the Asian session. And we'll touch a bit more on New York a little bit later, but those two things, we have members that strictly trade the stop run on the hourly chart and do extremely well with again the stop run on the hourly chart. And so we're going to start with that, and then we'll get into a little bit more intraday and the manipulation out of Asia. So real quickly, we're going to go to an hourly chart, and we'll just point out a few things. Again, we can't go through everything, but I want to save some time for questions. That's generally what leads us down the rest of the day. But when we go out to the hourly chart and we look at what ends moves and what tends to start moves, we start noticing something that we call the stop run. The stop run is its very basic principle is the fact that, again, because banks move such a large amount of money, they have to induce the other side of the market. And so they have to induce selling when they want to buy, and they have to induce buying when they want to sell. That's why stop runs tend to start moves and they tend to end moves. Because again, they're using it for entries, they're also using it for exits. If you have to enter over the course of time, they also have to exit over the course of time. And so the basic principle of the stop run is the fact that the market establishes highs. The smart money will establish, in this case, what we're going to look at here, we'll zoom into a 15-minute real quick. But the market will establish a high, and at the end of that move, they're going to run the price through that high before ultimately turning the market. Now we're going to look at quite a few examples of this because it happens almost every single time. And that's why a lot of traders, again, use strictly the stop run, maybe don't even use anything else that we teach, and they use the basic principle of the stop run. So you can see at the end of this move, we have an established high set. Now what happens around that high? What does the average retail trader do? You have two types of traders. Your first type of trader is the first type of trader may have sold expecting that high to hold. Now where does the stop go if you've sold in expectation of that high holding? In expectation of that high holding, stop loss goes above the high. So that's if you're stopped out of a short position, you have to buy it back. Hang on one second. Not seeing any charts. You guys seeing the charts? Any issue with charts? Just real quick before we move on. Okay. Uh, well, I would say log out and log back in, but I think the room is pegged at the max here. So I would listen to the voice, and I'm recording it right now, so hopefully this recording comes out fine. Anyway, so we see the high established, and as that high is established, we're looking. This is one trade we were actually talking about this in the forum. We were talking about this in the room because we saw the high established. There was a lot more context in and around it, but then we saw him drive the price through that high and ultimately turn it from that high. Now again, if we have the market turning, driving through that high and turning from that point, what's the purpose of that? How would that benefit smart money? Well, first and foremost, again, if you had somebody that was short and the high is getting blown out, they're having to buy it back. That's one type of buy order. You also have those that are buying on the breakout. So those that are buying on the breakout, that's the second type of buy order. Now, again, smart money, if they want to exit their overall long position, they've been driving the market up, by inducing that buying pressure, they're able to sell into the buying pressure, and that's what turns the market. I'm going to go through a few more examples of this, and then we'll go ahead and answer some questions here. So again, we'll go down to the very end of this move. What ends the move here? This is another trade we did very well on. It's actually a trade we closed out in the room for 120 or so pips. A lot of traders caught it. Gave a first example here, but speaking to strictly the stop run, and this is again what ends moves and what also starts moves. It's ending the move to the downside, starting the move back to the upside. We see a clear established low. We see the market take out that low before driving the price to the upside. What happens when that low is taken out? Again, this is an hourly chart. So what happens when that low is taken out? Well, as that low is taken out, we have those that were long expecting it to hold. They have to sell it as they're getting stopped out. And we also have those that are selling on the breakout. So there's that massing of retail sell orders below any major support point. Smart money drives it into those sell orders and buys into the selling pressure. Again, if you don't have a seller, there's nobody to buy it from. If you don't have a buyer, there's nobody to sell it to. And that's the basic principle of it. So as we move forward here, and again, we'll look at what stops the end of this move to the downside. And we're looking at an hourly perspective. You'll see this. We'll get into how you're going to see it every single day, or generally most days. But again, what stops this end move here? We see the market blow through those lows before ultimately starting the move back to the upside. And again, as we go through here, we'll see multiple examples of this. This was I'm pointing out ones that were pointed out in the room, and the reason for that is because it was the ones that I remember off the top of my head. But again, marking the end of this move, very clear stop run. The stop run, what makes this clear is the break through that point. Generally, I like to see a 5 to 10 pip break, bare minimum, and I want to see it retracing and closing back down, in this case below that resistance point within that same candle. So the point is not the candle formation, it's the fact that that is a clear established high. Around any high, you're going to have two types of retail traders. You're going to have those that are selling, expecting it to hold. They put their stop loss above the resistance. As they get stopped out, they have to buy it back. That's one type of buy order. And you have those that are buying on the break higher. With all that buying pressure above that point, again, they sell into the buying pressure. That's why you see the stop run at the end of the move. Marks the beginning, marks the end of a move. So again, we'll go into, this is actually another one. I think this might be a recent trade here. We'll zoom into a 15-minute chart real quick. But before the start of the move, we'll zoom over here real quick. We see them take out the Asian highs. They take out those Asian highs, ultimately driving the price back to the downside. And so again, we're just illustrating the point of the stop run. We're illustrating the point of the fact that at the beginning of each move and at the end of each move, you tend to see a stop run. We have traders that, again, and I say this because these are the things that are, somebody could take a very basic principle, apply that principle, and get out from using, the indicators that have, and I say this each time, and I say it hoping someday somebody's going to prove me wrong, but I've never met a trader who takes an indicator, strictly trades based off indicators on an exact strategy without any type of gut feel, and trades profitably with that strategy. Everybody has to answer that question for themselves, but there's a reason for that. And there's a reason the price is driven beyond support points before they turn it, and beyond resistance points before they turn it. Again, the market consistently will do this, and you'll see it repeatedly on a larger hourly scale, and you'll see it on a short-term scale. Now, the short-term scale is what we're going to get into next, and this is one of the clearer things that you're going to see throughout the given day, especially out of the Asian accumulation. So we'll go back to where we started here. Again, we started back in February 23rd. What we're going to do is we'll zoom into the 15-minute chart, and we'll see the consistency at which you see a manipulation move against. All right, guys, let me know if anybody else has an audio issue. Sorry about this. There's usually a couple that will have an audio issue. Audio's good, that's what I figured. Usually I can tell Audio, you guys, I'm talking now. Let me know if you guys have it still. Okay. All right, yeah, I must have just stopped talking for a second. Okay. So we're going to get into short-term manipulation. One thing, if you do lose audio, and I can't guarantee you get back in the room, guys, the one thing that tends to fix that is you log out and log back in. But again, once I'm sorry, we're pegged at 50. It allows 50 members, and then Chad and I, as far as a commentator, or as far as an administrator, and I should have planned on a different server for this one, but Novi has not got back to me yet, which is the real issue here. So, anyways, let's move on. If you know if you lost sound, like I said, the one thing that fixes that is logging out and logging back in. So that's again, if you lost sound, we can't really stop for one thing there. So moving forward, we'll start with the manipulation you're going to see before most moves. I'm just going to focus on the Asian session here. And the reason I'm going to focus on that is because, again, I can't cover every single thing. We'll get into basics. I've covered a lot in some recent videos that you can use to judge things in context. But the stopper on the hourly chart, extremely powerful tool. There's other information on that on the site. There's more information on you know further explanation on that point. The second point I want to have before we start to answer questions, I know a lot of people have been through a lot of information on the site. If they have questions on really anything, we'll answer that. But I want to go through the Asian accumulation and give a little bit clearer point on that. Okay, so once we've again, the way the market tends to run, and this is a very common thing. There's a name for the manipulation out of Asia. It amazes me that you don't see more people looking at this because it is, as far as, and I hate to use the word pattern, but is the most consistent pattern that you will see in this market. And that's because, again, they have to induce the other side of the market. If they're going to buy, they need sellers. If they're going to sell, they have to have somebody buying it from them. Now, banks move not only their speculative orders, but they're also using again what we call general order flow. Now, with general order flow, that's the order flow for worldwide commerce to take place. You have people that need to exchange pounds for dollars, euros for pounds, whatever it may be. There's general order flow. Now, this general order flow is used again to manipulate price. If they want to buy the market, inducing selling, pushing through certain general order flow to induce the market to move one way, and again, starting to trap traders. As you have this, as you have this, cannot talk. Sorry about that, guys. If you have this Asian accumulation, this is typical of what you're going to see, and again, we'll go back through quite a few examples of this as we move forward. But after a while, you got to start asking: is it coincidence that you see a manipulation move almost every single time before the market runs? Even during New York here, we see a clear low. They take out the lows before driving the price up. We come up to the Asian session. We see them take out the lows, start to induce London breakout traders, common strategy. Anybody that was long putting their stop below the support gets taken out. They have to sell it back. There's a massive retail sells below any clear support point. Smart money knows if they drive the market into that position or below any support, they're going to start to trigger those sell orders. At that point, they're buying into the selling pressure, which is why you see the manipulation move at the end of generally that accumulation period. So again, we'll go back and we'll start to go over to where the market begins to fall. And we see here again, during the Asian session, we have a nice tight stagnant accumulation. And what happens before the market moves down? We see them take out the highs before moving the market to the downside. Very common thing here. Now, we're not going to get into levels, guys. Level is where we understand. You'll see chart labeled 1, 2, 3. That's where we begin to understand which direction we should be looking for the manipulation, or where the probability of the manipulation comes from. There's a video on that I did where you guys can go over that. That was, I posted a kind of walking through a little mini series, and you guys can go over that. That's where we get a little bit more context. I'm just going over the basics of it because again, we have traders that uh, I've had emails, and I've had one a couple days ago where they say, I can't grasp what you're talking about with the levels, but as far as the manipulation goes, they strictly trade hourly stop runs and they trade Asian accumulation breaks. And the reason for that is because that's one of the most basic things you're going to see in this market. It's one of the most consistent things you're going to see in this market. It also allows you to pinpoint, as far as Asian accumulation goes, it allows you to pinpoint the time of your trade. You know that, if you're not getting a trade between 1:30 and 3, 1:30 and 4, roughly around that time, then you're not having an opportunity for a position on that day. So going forward again, as we move through to the next push here again, this was a trade that we were mentioning in the room, and generally what we're going to see is we're going to see either a stop run or that topping or bottoming formation. Essentially, a topping formation is a market coming up making that stop run or double top, double bottom formation. So what we had here is we had an accumulation through Asia, and again, before even the move up, what do? They take out the lows, come up, take out the highs. This is a trade we were posting in the forums. The trade a lot of traders got because it was a clear move, in the fact that generally we see that manipulation end up 30-40 pips outside of Asia. They drive the price up about 25-26 pips here before turning the price back to the downside. Again, it was in context of the overall push we were looking at too. So we'll come back down, and we'll get into some really clear examples here on the way back to the upside. Let's see, let me zoom out real quick. All right, this is actually in a market review. Posted this on the site. Well, let me zoom forward here. Take out the lows before moving the market back to the upside. Shocking. But let's get into this Asian accumulation. Now, this is actually a market review that's on the site because we were, 12, 14 hours in advance, we were talking about, okay, we're going to look for the Asian accumulation. We're going to look for them to manipulate down before ultimately driving the price up. Now, the reason we did this is because of the overall push that we were in, which, again, I'm not really going to get into much today. But, again, looking for the manipulation outside of Asia. The keys here, guys, some basic principles you can use is that generally they're going to, during the Asian session, you'll have a fairly tight range. That's your best opportunity when you have a fairly tight range. So they're going to set, obviously, within a range. Every range has a high or a low. And generally outside of that range, a safe bet is to look for the manipulation to end around 20 to 40 pips in that region. It's never exact because, again, we're looking for a range there. But also, you got to figure, back in 2008, if you guys were around during that time, you'll know that the pound, the pound yen very commonly had 4 or 500 pip days. Pound yen would have 1,200 pip weeks. So the manipulation was a bit deeper. That does change with the volatility as time goes on. But the fact that they're going to drive the price against the overall push is something that will never change. And that's because it's a basic fundamental. They have to have sellers if they want to buy, and they have to have buyers if they want to sell. That basic principle is where the manipulation comes from. And again, why it will never change, whether it's now or whether it's 10 years from now. So when we learn to trade the manipulation, when we learn all the little nuances with it, when we learn the overall perspective, which direction we should be looking for the manipulation, it's something that's not going to change. And that's because, again, they have to have buyers when they want to sell, and they have to have sellers when they want to buy. So we'll go forward again. And what do we see? We see more Asian accumulation. We see them take out the stops low, induce selling, buy into the selling pressure. So again, we'll go back to, let's find some other things I wanted to point out here. Now, this is a trade, and again, there's probably 1,000 examples through there, guys. I'm looking for clear examples because I want to show the best things that can help somebody moving forward. Well, the thing is, when we talk about smart money, and this is one of the parts in the course, one thing we mention is when we say smart money, uh, we're not just simply talking about retail orders. Smart money is the mega banks. Now, outside of the mega banks, you have large funds moving a very large quantity of money. You have those on the floor outside of smart money's general order processing that is moving volume. A lot of floor traders, what people don't understand is they're trading for personal funds. They're trading their own funds. There's a good video out talking about floor traders. It's actually a little series called Floored, and the majority of floor traders are traders that are moving their own money personally, or their small funds that they trade, and they're trading, again, their own money. So this is a competition not just versus the retail trader, because the retail traders, in essence, only make up about 10 to 15% of the volume on any given day, but it's also everything outside of the banking industry. The banks control the vast majority, but outside of that, there is, again, there's other competition outside of that, which competition is liquidity. And liquidity is something they need in order to enter a position. Yes, they do. Yes, you will see collaboration. That's a very common thing as far as, hey, there's, if it costs them $500 million or $1 billion to drive the price up into an area where they know there's going to be 20, 30 billion to either buy into that selling pressure or sell into the buying pressure. If they know it benefits them to drive the price into those orders, again, if it costs X amount and you're getting X times 10, it's worth it for them to drive the market into that point. And there's also, I should find that video, but there's some good video on how, again, how they do that. Uh, is that information important to, exactly? I mean, is that information important for us to understand exactly which bank is working with who exactly they're manipulating? No, it's really not. It's you know it's educational, and it's interesting information. The important part for us is really lays in the foundation, and that is they need sellers when they want to buy, they need buyers when they want to sell. So out of the Asian accumulation, here's the single question that really needs to be answered. And what I'll do is I'll mark this up. Accumulation is found, again, through what most people would term as a range-bound market. It's one of the biggest lies in the market. Everybody says don't trade a range-bound market. Range-bound markets mean nothing. There's nothing going on there. One of the biggest lies, because when you see this tight, stagnant, range-bound market, your single question now becomes, what are they accumulating? What answers what they're accumulating is the stop run or that false push. By them driving the price up, immediately slamming the price back to the downside, that tells you one thing. That tells you they were driving the price up, inducing buying pressure. They immediately sold into that buying pressure. If they were selling into the buying pressure here on the stop run, then they were selling through all this accumulation. And that's why we see the push down. We're going to go over to this point here. This is a day where I'll brag on Daniel here. Daniel took about, correct me if I'm wrong, 450 pips on this day. Not on specifically the euro, but it was spread between a few pairs. But again, what he looked at was the fact that, again, going back to a very basic principle, and he saw this on the euro yen, you can see it on a few other pairs. But he goes back to the basic fact that they were accumulating through this point. Asia had ended, and he saw the false push above the highs, and they immediately rejected it back down. That tells you one thing. That tells you they were inducing buying by driving the price above that high and then selling into the buying pressure. If they were selling into the buying pressure on the stop run, then they were selling all through this accumulation. Really, guys, it goes back to a basic principle that's heavily overlooked. Everybody tells you to avoid range-bound markets. Everybody tells you to, they mean nothing. Nobody wants to pick a direction. When in all essence, it's exactly the opposite. The banks are accumulating through this time. There's a great video that was somebody sent me, and it was a guy. He runs something for gold. He talks about gold and how the banks accumulate positions through the Asian market and manipulate through New York. and it was a great video. I'll see if I can't get it up and get Chad to post it in his commentary today, because it's a useful video. It also talks to the fact that again, how banks manipulate the market. This is April 4th and 5th. So guys, that was what I really wanted to go over. I wanted to go over that a bit more. I know we've had the reason we're running this training session, the reason we'll probably run some more in the future, they're going to be a lot more organized in the future. Again, I had this kind of dumped on me last minute, guys. Helder was supposed to run this training session, um, but again, had that dumped on me last minute. So why you're getting me today, and while I'm happy to be here, happy to answer questions. The the basis here was the fact that I wanted to show the manipulation, how the manipulation can be the one key to somebody's profitable trading. Without a doubt, I go days without finding a trade, and I will be the first one to tell you. In the last 2 days, I've taken two losses, and because I've very simply, the manipulation didn't have follow through. Both of those trades gave up. The euro trade, some people took it in the room and it gave up about 50 pips, but that's not enough for us to take profit. Generally, one good rule of thumb, guys, is that you're going to see, if you've truly identified that smart money has manipulated the market and you've truly identified a stop run, then what that tells you is that you're in for at least a 90 or 100 pip move. And so when we only see a 50 pip move, a lot of times I'm not going to take profit on that, because profitability comes from two things: your win loss and your risk reward. And somebody trading with a 2-to-1 risk reward, which when you've identified a stop run is is a small risk reward, because we're entering with 20 pip stops and we're expecting 90, 100 pip moves, so it allows for 3-to-1, 4-to-1. But when when we spotted that move, there was, like we've seen, actually I'll point it out here, a trade that we were looking at yesterday. A couple people took. We were writing it in the forum. We had this established high. This is the high was on the 10th, and the stop run came on the 11th. We had a stop run through that high, came back up, created another stop run through that high. A lot of members saw roughly 50 pips of profit. Some people had it come back to break even because they were expecting this level 3 type accumulation to break, but it just never broke to the downside. It was a good trade, gave up some pips, but not quite meeting our criteria for the length of the move we want to see. Again, when you've truly identified the manipulation, you gotta ask yourself this: if they took hours to accumulate through Asia, and they manipulated the price at the end of Asia, generally start of New York, within that couple-hour window, if they've accumulated for that length of time, or they've accumulated for that length of time, wouldn't it make sense that it would take them a good distance to exit that position as well? If it took them hours to accumulate, it's going to take them a while to exit that position. That's the Achilles heel of smart money, and why they're trackable. Because of the position size they enter, they're trackable. They're trackable with the fact that this move up started with them. Again, let me get this here. Why did they take out the stops low before driving the price to the upside? Why did they, again, at the highs, why did they create a stop run on the highs before driving the price to the downside? The stop run can be the single most important thing for somebody to profit from. Because it's not an easy sell. I mean, you guys know, and hopefully people that have been around the site know me enough. I mean, at the beginning of this webinar, I told you two other people that you can learn this from, and they both sell a product. Chad and I are here to help traders. We've been around for a long time, and we're here to help traders. And the bottom line is, it's hard to tell somebody, hey, we're going to put as much work into you as you're going to put into yourself, but it will require work out of you. Chad and I put a lot of work into our members, and we see a lot of success. A couple members have, last couple months have outperformed me, and I'm happy about that. That's the best judge of success I can have. Fred, I don't know about all that, but we try. I mean, we try and do the best we can. And again, like I was saying, I don't know why more people don't teach it. I think a lot of it has to do with the fact that it's easy to sell somebody, hey, there's the belief that there's an indicator or there's an EA or there's a price pattern or there's a chart pattern that in and of itself is going to make somebody profitable, uh, is is a belief that perpetuates this market. This is extremely over advertised market. And so when you tell somebody, let's get back to basics. Let's go to the very foundation of how the market works. The market works because banks accumulate positions, they then manipulate the price, and then they trend the price this far. This is how they trend the price. This is how we're going to read how they trend the price. This is what we're going to look for on a daily basis. All these people, they start to hear work. All they hear with my words is, well, that's going to require effort on my part. That doesn't require me just putting an EA on my charts and it trading for me. One thing I always like to say is I'm going to love the day. I want somebody, I'm begging somebody to prove me wrong. Send me an indicator or send me an EA that is profitable. It'll never happen. The reason I know that is because you have to ask yourself this question, guys. We know how brokers work, right? When you buy, they sell it to you for the most part. Go read, Alpara US's risk disclosure statement or their counterparty agreement. They tell you right offhand, you should be leery of anything we tell you because we benefit when you lose and we lose when you benefit. They literally say you should be careful of anything we tell you because we're in direct conflict with you. And so then I say to myself, and everybody has to answer this question for themselves. I can't answer it for you. Um, if that's the case, then let's look at the free education that these types of brokers offer. And if that's the case, why do they teach you EAs? Why do they teach you indicators? Why do they teach you chart patterns? Why do they teach you candle patterns? Why do they teach you different indicators, etc., etc.? Go look through the brokers for yourself. And so, well, my basic principle is if the brokers are teaching it, it's a losing strategy because they know based on their model they have to have losing traders. Yes, they profit from the spread, so if you're a break even trader, it's still going to make money off you. But they have to have losing traders because if they don't, their business model fails. And so they know that if they can keep people in that limbo where the trades pay out sometimes, they don't pay out other times, generally overall break even at best, losing more than likely. That's right where they want to keep traders, and that's why again we have the failure rate. It's such an extremely simple uh, foundation. Again, if they take the counterparty to your trade, they lose when you profit. They profit when you lose. And so if they're teaching you a strategy, you have to be leery of it. You have to be. There's no other option. Yeah, that's exactly it. Um, that's our job as a trader, and what's going to separate a profitable trader from a losing trader is whether you understand the very basic principle that the banks are the single driving force of this market. If we know what they're doing, we don't need another piece of information. So once we identify that banks accumulate, they then manipulate the price, and then they trend the price. Once we understand that basic foundation, then we can build on it. Then we can build on, okay, well, how do they trend the price? When should we look for this manipulation? Uh, how do they drive the price intraday? How far do they tend to drive the price intraday? How far do they tend to drive the price on a weekly basis? How long do they trend the market for? And so, exactly, and these are things that again Chad and I talk about on the in the videos that we put out on the site.